Okay, folks, we're blast off time, so welcome back. And I'm sure people will join as we go along. But as always, we're going to start the class with a pre-class test. And today, as I said, we're going to talk about the loose ends in valuation. You're probably wondering what loose ends. We've covered cash flows, for growth rates, we've covered discount rates, we've covered terminal values, and that all there is in DCF valuation. I wish that was true because there are lots of loose ends. So let's start with a very simple question. And companies across the world accumulate cash in the balance sheets. And there are lots of reasons to keep cash, right? As a company, you're keeping cash because you worry about a recession, you worry you might need the cash, you keep cash because you might have projects that come along. But let's face it, some companies accumulate incredible amounts of cash. Like how much? Apple at one point had $250 billion in cash. Think about that, $250 billion in cash. It still has more than 150 billion. Google has 100 billion plus. Berkshire Hathaway has 125 billion. And that cash, to be classified as cash in a balance sheet, has been invested in something liquid and riskless, T-bills, commercial paper, which means right now that cash is earning pretty close to nothing. So an analyst is looking at a company with a big cash balance. It could be any of these companies that I mentioned, right? And then the analyst says, look, cash is earning a really low rate of return. That's true. That low rate of return is much lower than the company's cost of capital, which is also true. And then he says, that must mean this company is actually reducing value by holding cash because its returns on cash are much lower than the cost. Remember we said you need to make more than your cost of capital. It's kind of embedded in people's minds. So cash seems to be a money wasting investment, right? Because you're earning well below the cost of capital. So my question to you is, what's wrong? This is obviously wrong because if this were true, then the Googles and the Apples should be punished. What is wrong with this analyst's reasoning? Why is that statement false? Dave, do you want to take that on? What is the analyst missing when he says the return on cash is lower than the cost of capital, therefore cash is a wasting asset?
So I think he's like the analyst is wrong because
I can't hear you, Dave. Is that my problem? Maybe it's my problem. Hang on.
Can you hear me now?
That's my problem. Sorry.
That's okay.
Okay. Give me a minute. Come on. Yeah, now I can hear you. Yeah.
Like there's two different ways. There's one, there's kind of strategic flexibility with having cash on hand in terms of kind of risk. And I think the other thing is there's also just the opportunity cost of just taking an investment now with a particular kind of cost of capital.
You're playing into my hands though, right? Because then I can say, okay, that makes sense, but how much cash do you need for straight? Do you really need 125 billion as Berkshire Hathaway, 250 billion? I mean, there's almost nothing that these companies can do in the near term that would suck up that much cash, right?
Yeah, that's true.
Your reasoning is, I'm hurting you, but you know what? I'm getting benefits in return. But think of how much you're leaving on the table if you're making almost nothing on that cash, 150 billion cash when you should have a cost of capital of 8%.
Are there other kind of considerations like regulatory in terms of like overexpansion?
It's still playing into my hands. I'm going to give you a starting point. When we look at a project and we ask, what's the value added or created by the project? What's the discount rate you use to discount the cash flows in a project? In corporate finance, we said the discount rate has to reflect the risk of the project you're invested in, right? It doesn't reflect the entity taking the project. It's the risk of the project that you take. When you see cash invested in something liquid and riskless, you know what discount rate you should be using on that cash? What you or I could earn on something liquid or riskless, which right now is close to nothing. They're earning close to nothing. They need to make close to nothing. Cash is the ultimate neutral asset, which is one reason you don't see Google and Apple being punished for the cash. But there are some companies where you worry about cash. We're going to come and talk about what worries. It's not that the cash earns a low rate of return. It's what those managers can do with the cash that terrifies you. So we're going to come back and isolate cash because there's a huge amount of misconception about cash and what it does to companies. But I want you to start thinking about risk-adjusted discount rates and how it plays out across a company. Let's move to second.
Just to be clear, when you say close to nothing, you mean risk-free rate, right? So if the risk-free rate was high, then it wouldn't be the best.
It's what you make on T-bills and commercial paper right now. What's a rate? So risk-free rate is kind of a generic term. In this case, it's not just risk-free, it's risk-free and it's liquid, right? A T-bond is not risk-free in that sense because it's not liquid. If you bought a T-bond, you're kind of locked in, its price can change. It has to be T-bills or commercial paper. And right now that rate is like 0.03%, 0.05%.
Yeah.
So now let's try something that I think is perhaps the most complicated part of the loose ends, which is when companies have cross holdings. The reason for that is the accounting for cross holdings is a bit of a mess. So this is as much a joint test of what you understand about valuation and what you remember from accounting. So I already scared you off on that. But John LaBelle, you want to help me out here? How solid do you feel on accounting? You think are you okay on it?
Maybe not as well as some, but I think I'll give it a shot. I can make this happen.
Right. So let's say company A owns 60% of company B. That number is significant. And it has consolidated financial statements. So when you take the financial statements, you're trying to estimate cash flows and value, because remember, you use the income statement to get operating income, get started in cash flows. How much of company B is going to show up in your value? So you've taken the consolidated income statement and to get to the cash flows. How much of company B is going to be reflected in your value?
You're going to see 100% of the income statement, but you should only see 60% of company B in your value.
So already you can see when you have a consolidated statement, you're going to value. So to clean up, what do you need to do?
You need to take care of the non-controlling interest.
You need to take out the 40%. So already you've laid the foundations for what do I need to do with it. Let's change it a little bit. Let's suppose I'm going to keep you on because you got the first question so perfectly right. You own 10% of company B. And I still use your financial statements. I use your operating income, your tax rate, et cetera, to get to cash flows. How much of company B is now going to show up in my value?
It should only be 10% now if it's only 10% of B.
See, but I start with operating income. When you have a minority holding in another company, that income shows up below your operating income line. It's one of those quirks in accounting. You don't even think about it. But if you start with operating income for this company and do the valuation, you actually valued none of that holding. Which means if you have a lot of minority holdings and you're doing a free cash flow to the firm, guess what? None of those minority holdings have been reflected in your value. This is a nightmare if you think about a company with dozens of cross holdings, because you're dancing this dance. And if you have joint ventures, I'm going to give you other ways in which they're accounted for. Bringing them in is a huge mess. We're going to talk about the right way to do it and why that might not work in many companies because you don't have the information. So let's say at this stage, here's what you've done. You've taken cash flows, you've discounted them at the cost of capital, you've come up with the value of the operating assets, you've dealt with cash, you've dealt with cross holdings. And you just want to make sure you haven't missed anything. So you make in my view, a horrendous mistake. You open the balance sheet and you start looking for things you might have missed. So D who? So you're going to help me out here. So I've finished my valuation. I've added cash. I've cleaned up across holdings. I'm looking at the balance sheet. And I'm going to start listing items that I see on the balance sheet and ask you, should I be adding this on too? Because they own this. This company owns its headquarters building in New York, which could be $500 million, $1 billion. It's a big building. Should I add that on to my value?
No, I would say.
And tell me why not.
Because I'm not selling my headquarters tomorrow.
And who's in those headquarters? Presumably your employees. And what are they doing? Something useful, I would think, which shows up in your cash flows. You cannot eat your cake and have it too. If you count the cash flows from an investment, you can't do the cash flows and then, oh, by the way, this building is where those cash flows come from. Let me add the value of the building. That'd be double counting. What if it's vacant land owned by this company?
And I would
Nothing
think
sitting on it. Then you can say, you know what? I haven't counted that yet. It's not in my cash flows. I'm going to add it. You can already see that as you go to the balance sheet, you got to be careful. What if you have patents as a company? You're a pharmaceutical company and you see patents. Should I add the value of the patents?
I would say yes, because that's part of the.
What's the test we ran on the headquarters building? Have I counted that already, right? Let's ask the question. Have I counted the patents somewhere already? What do I need to check first? When I did my cash flows, I projected growth, right? You projected growth. When you projected the growth, what do you base it on? You base it on the fact that they own all these valuable patents, they're going to develop them. Be careful, because if you count that growth in your cash flows and you count the patents, again, that's double counting. What about brand name? I mean, many companies now are bringing brand name onto the books. Accountants are coming up with an estimate of brand name. They're saying it's worth 5 billion. Robert, do you think I should add the value of the brand name to my discounted cash flow valuation? Again, ask, what's the rubric we suggested? Is it in my value already? Is brand name in your value already?
Since I'm guessing, but since it's off balance sheet, maybe it's not incorporated.
No, but this is after you've done your DCF. You estimate the operating income, the growth rate, the cash flows. So this is after you've done the DCF, right?
Okay, so it's already
There's some way it
incorporated.
showed up in your cash flows already?
It built into the margin.
It's built into the margins, it's built into the cash flows. Brand name, it's already been counted in. What about goodwill? Sergio, what do you think? This is an easy one, slam dunk it for me. What does goodwill measure? Absolutely
yes,
nothing.
like,
It's a plug variable, right? This is, you should draw a line and say, you know how many times I get emailed every week from people saying, I value the company, but it's 5 billion in goodwill. Should I add it on? Just let the damn thing go. It's useless. What if your CEO has gone crazy? He's been buying Picassos every year for the last 10 years. With company money. And technically, it belongs to you, right? What about that Fifth Avenue apartment he maintains just for the 7 days he shows up? Or the, you see where I'm going there? Once you're done with the DCF, the mopping up can be all of these things that haven't shown up in your DCF. But monetizing them might actually be very difficult to do. So with that setup, let me start on this discussion loose ends, because a lot of interesting loose ends that we're going to deal with. So let me give you the place from which this part of the presentation came about, because different parts of the presentation were born in different parts of this class, right? Some I added in 2003, some in 2005. This I added probably about 14 or 15 years ago. Now understand what what I'm going to try to do here. I'm going to give you a little bit of a sense of how difficult my life is. Now, I am an academic. I have a teaching load of like 3 classes a year. I'd have to teach like 4.5 hours a week. And because I work so, and also I get summers off and I get, weeks off in the middle. So basically I work about 8 months a year, 4.5 to 5 hours a week. And because I work so hard, every 7th year I get the whole year off with pay. It's called a sabbatical. If you ever hear a professor complain about how hard his life is, slap him around the face if you can get away with it. This is about as easy a life as you can get. So this was, I had a sabbatical coming to you, and I decided to take it. And you know what my plan, usually when people have sabbaticals, they have big plans, they're going to write a book, they're going to do this. You know what my plan was? To do absolutely nothing for a whole year. I wanted to wake up every day with a to-do list with nothing to do. So first day of my sabbatical, I decided to do this, and I'm a little ostentatious about this. So what I do is I go to Staples and I buy one of those to-do, the to-do things you can hang up on the wall. I hang it up at home above my little place of where I work. And as my kids were, and they all were at home still, they were all going to school. And as they came down the stairs getting ready for school, I pointed to my to-do list and said, look, I have nothing to do today. Pissed them off no end. But they left for school, and then I made my fatal mistake. My wife came down the stairs, and I said, hon, I have nothing to do today. She said, really? Why don't you take the dog for a walk? So I take the dog for a walk. I come back, there's something on my to-do list. I said, what the heck is this? Say, pick up bok choy at the grocery store. I'll be quite honest, I didn't even know what bok choy looked like. I was too embarrassed to ask. I walked for an hour and a half. It turns out to be ugly looking cabbage. And I come back and say, pick up kids from school, and item after item starts to show up on my to-do list. Now, finally, after the 7th or 8th item showing up, I said, look, I've got to find things to do just to keep my wife off my list. I'm desperate. And then I get this email from the editor of CFA magazine, a magazine I didn't even know existed. He said, would you write a one-page article for us? My normal reaction is, I'm on sabbatical, I want nothing to do. But then I remembered I needed things to do to keep my wife off my list. I said, of course. And right after I committed to that, I wrote in big letters, write one-page article for CFA magazine, cannot pick up bok choy kids, et cetera, et cetera, et cetera. And I did write that one-page article, and I have to tell you, it's the only thing I've written that's got me hate mail. You know how difficult it is to get hate mail in corporate finance? People don't feel strongly enough to hate you. Nobody says, I hate you for using bottom-up betas. But this did get me hate mail because of the title of the article. It said, stop the garnishing. You know what I was talking about, right? In many appraisal and valuation houses, you finish valuing a company and then you start garnishing the value. By doing what? Adding 20% for control, 30% synergy, knocking 15. I said, you got to stop this, because if you don't do this, you're going to end up with the number you wanted to see in the first place. It defeats the whole point. And in that one-page article, I might have used the word arbitrary to describe some of these premiums and discounts, which pissed a lot of people off. So the wave of hate mail starts to come in. How dare you call it arbitrary? This control is backed up by this study. This illiquidity discount is backed up by... And there's one email that I got that actually cut to the chase. They said, if you don't like the way we're dealing with control and liquidity, why don't you come up with a better way of doing it? And I thought that was legitimate. I'm not saying control doesn't have value. I just don't like adding 20% for it. I'm not saying liquidity doesn't matter, but why are you always knocking off 25%? So I said, you know what? I have 11 months left on my sabbatical. Here's what I'm going to do. Each month, I'm going to pick up a loose end. And I'm going to spend the entire month talking about how I would value the loose end. So month one, I picked up control. Month 2, liquidity. Month 3, employee compensation. And what you're going to see in the rest of this class is a summary of what I spent the next 11 months doing. Incidentally, what I spent the next 11 months doing has become half of one of my valuation books, The Modern Valuation. The second half of the book is so my objective of doing absolutely nothing during my sabbatical kind of was broken up, but something productive came out of it. So you ready? Here's what we're going to talk about for the rest of this class. We're going to start. So you've taken free cash for the firm, you've discounted the cost of capital, you come up with the value of the operating assets of the company, right? That's your starting point. What's the first thing you have to deal with? Cash and marketable securities. Now, when I started this class with cash, remember what I said, don't play games with it. If you have 100 million in cash, it's worth 100 million. Today, I'm going to violate that principle and argue that sometimes you see a company with 100 million in cash, you might attach a discount to the cash. Not because it earns a low rate of return, but because you're worried of what the management of that company will do with the cash. Sometimes you might actually attach a premium to the cash. Why? Because you have expectations of what this company can do with the cash. I'm going to talk about under what conditions would you discount and premium cash. Let's start with that. Next, I'm going to talk about cross holdings. In a perfect world, how would I value cross holdings? The world we're in, with the information we're given, what are the approximations we can use? Then I want to talk about mopping up. Remember what we talked about, when would you add, when would you subtract? What are the things I would add on to a DCF valuation without risking double counting? vacant land versus the headquarters building. I'm going to draw that out more specifically. Once I get the value of the firm, I'm also going to ask a question that some of you will deal with as you value a company. For some of you, valuing a company is going to be relatively simple. You're going to open up the annual report. The company is going to tell you what they do, and they're pretty clear about what they do. The financials are pretty transparent. And 2 hours later, you're done. You call somebody in your group and say, how is it going? And he says, I'm still on page 7 of the annual report. I don't even know what language this annual report is written in. It's incredibly complicated. It's around 500 pages. Let's face it, some companies are easier to value than others. I'm going to talk about complexity. How do you bring that into valuation? Should we punish companies that are incredibly complicated? And if so, how would we do it? I want to talk about dealing with debt. We said debt is any interest-bearing debt and leases. But what if you're the target of a lawsuit? How do I factor that in? What are some of the other items I might need to net out to get to value of equity? And finally, I want to talk about employee compensation that takes the form of equity. It used to be primarily options until about 20 years ago. Increasingly, it shifted away from options to restricted stock. But if you open up any big company today, especially if it's a young company, an Airbnb, a Facebook, you're going to see a huge amount of the compensation employees takes the form of equity. How do we deal with that in valuation? So we've got a lot to do. Let's start with cash. I already told you, don't punish cash for the wrong reasons. Punishing cash for the wrong reasons is it earns too low a return, therefore it's got to be discounted. That's not the case because it earns exactly the rate of return it should be making. When you're valuing equity, sometimes it's easy to mess up cash because income from cash becomes part of your net income. And before you know it, you're discounting that net income driven cash flow at a cost of equity. Already you're discounting cash income, which is riskless at the wrong discount rate. When you value the firm though, cash is set to the side, right? Because you take the operating income, the operating cash flows, you discount the cost of capital. It's only after you're done with that that you turn to cash. See, what can happen there? I'm going to give you a very simplistic example. And so here you're going to be the one who lets me decipher these three companies. So these three companies have exactly the same enterprise value, $1 billion. They all have 100 million in cash. The cash is, you can see it, it's right there. But here's how they're different. Company A has a return on capital of 10% and a cost of capital of 10%, and it's a developed market company. Company B has historically earned a return on capital of 5%. All I can give you is history. Historically earned a 5% return on capital. Its cost of capital has been 10%, and it's also a developed market company. Company C has historically earned a 22% return on capital. Its cost of capital is higher, 12%, but it's an Argentine company. All three have 100 million cash, right? I'm going to argue that in one of these companies, cash is likely to be a neutral asset. In one of these companies, you will discount the cash. And in one of these companies, you will attach a premium to the cash. So here I'm going to give you the easy one. In which of these three companies is cash likely to be a neutral asset? It's 100 million is worth 100 million.
Company A.
And what is it about company A that makes cash a neutral asset?
Their return on invested capital is the same as their cost of capital.
I describe company A as a block company. You know what block companies do? They don't add value, they don't destroy value, they kind of run in place. You're not going to get excited. This is not the company you want to talk about at a cocktail party. Say, I own block company. That was the easy one. Josh, I'm going to give you the more difficult one. Which of these three companies would you discount the cash? And you got to tell me why you would discount the cash.
I think, Josh here, I think I would discount the cash in company C because they can do a lot better on it because the return on invested capital is so much higher.
Okay, so does everybody agree with Josh, or does somebody want to argue otherwise? So basically you're punishing companies with high returns then because they're not taking the cash and investing at those high returns?
Yes, correct.
We'll come back to that. I think you have a core argument that's true, but let's see why that might not lead to a punishment. I think what you're arguing for is not a punishment, but they could be worth even more, right? So the cash is not destroying value, but you're saying it could be worth 180 million if the 100 million were invested. What's the problem with company B? Matthew, when you look at company B, what do you see? I see a garbage. I mean, it was a trash can fire. I don't know what the right description of it. This is a company that has a history of doing what? Of stupidity. Hey, might not be the right way to describe it. But I think on company B, you will discount the cash. And I'm going to call it a stupidity discount. You know why? Because it's not the cash itself that worries. It's the history of this company. What are they capable of doing? Screwing you up by taking more bad investments with the cash. It's not cash by itself that you worry about. It's what management might do with the cash. And in this case, you're saying, I don't trust company B. We'll discount the cash. Company C, Josh has a point, but here's why you should be cautious. You know what Apple's return on capital is, right? It's about 35%. They have $250 billion in cash. If I told you that they should just take the $250 billion, invest it at 35%, what is it that I'm missing? Where are they making the 35%? They're making it on their iPhone, their iPad. Basically, they're investments that they made 20 years ago. They're nice, mature investments. Throwing $250 billion in the iPhone business is not going to bring them much in returns because it's a business they already dominate. The fact that a company has a high return on capital in existing investments doesn't mean they have an unlimited amount of investments left in there. In fact, I'll wager that if you look at a Google, a Facebook, and Apple, the bulk of their high returns came from investments they made 15, 20 years ago, established businesses. It's not coming from new investments. So I would agree with you if they have all these projects out there that make 22% returns and they're not making them. But there it's a question of lost additional value, not a discounted value. So I'm not going to discount the value. But is it a good thing? I mean, why did I make this company an Argentine company, you think? What was the reason for that? I mean, if you know the history of Argentina over the last 20 years, this is a country that has gone through at least 4, maybe 5 crises where the entire capital markets have shut down. You know what I mean by capital markets shut down? You can't raise equity, you can't borrow money. The advantage of having cash in these companies, especially if you're a company with good projects like Company C does, you know what that cash is going to allow them to do? During the next crisis, it's going to let them survive, and not just survive, be able to buy other companies' assets at pennies on the dollar. You might actually attach a premium in emerging market companies when you have a really good, I'm not saying every emerging market company are going to do this, but emerging markets, we have good companies, having cash will allow you to survive that next crisis, and that's a huge plus. So what it basically means is cash in the hands of a company could be premiumed, it could be discounted. So you're not discounting the cash for the fact that it has low returns. You're discounting the cash because you don't trust the management with your cash. Incidentally, if you look at company B, and I told you it's a discount, I mean, that sounds absolutely, you think, do markets actually do this? Do they actually punish some companies for having cash because they don't trust the management? It is actually it's one of the more, I don't read a lot of academic research, but this is actually one of the more fascinating studies that I've ever seen. It actually looked at how much markets value $1 in cash in the hands of a company. At least every DCF model, we assume $1 in cash is worth $1. So this study actually is that true? So they looked across all US companies and they came up with a very creative way of looking at how much $1 in cash is worth. They looked at the market cap of the company, the cash balance, and they actually ran a regression with the coefficient on the cash balance. If it was 1, basically meant $1 in cash is valued at $1. So I'll give you the good news first. Across all US companies, $1 in cash is valued at roughly $1. You know why that's good news, right? Because that's what we do in every valuation. You see, this is good, let's move on. Not so fast. When they broke those companies down into mature companies with negative excess returns, you know what I mean by that? Companies like Company B. $1 in cash was valued at 69 cents. Think about that. A 31% discount on the cash balance. Why? Because investors don't trust you with the cash. Now, I've said this about Carl Icahn before, and I'll say it again. The guy's not the deepest thinker in the world. He says some really stupid things. Like sometimes, and I remember him when he was an activist at Apple, he said, why doesn't Apple go out and borrow 500 billion at 3%? That cost of capital would drop. You can't go out and borrow another 500 billion and expect the rate to stay the same. But he has one very good skill. He is, and this is true for all activist investors, the very best activist investors pick the right firms to target. You see what I'm talking about? What's happening in this in these mature companies? 100 billion in cash is being valued at 69 billion, right? There's a 31% discount. All the company has to do to make that discount go away is to do what? People don't trust you with the cash. They're worried that you might screw up with the cash. What can you do to make the discount go away? Neil, you're a company, a mature company, you have 10 billion in cash. The market is acting like you have only 6 billion because they don't trust you. It's the easiest way to make the discount go away. You can try to earn trust back, right? But that's going to take a really, really long time, and they might never trust you ever.
Spend it.
Oh, don't spend it, because that'll reinforce everything they knew about you, which is this guy's crazy. He's good. Just give the damn thing back. Right? Pay a special dividend, buy back stock. Overnight, there goes the discount. Now do you see why Carl Icahn's favorite pitch works so well? What's his pitch? He finds a company which nobody trusts. The management has a bad track record. It's a big cash balance. What's the first thing he pushes the company to do? Pay a dividend, buy back stock. It's effectively making the discount go away. It's very simplistic, but you can see when people don't trust you with the cash, why just returning the cash can overnight make your investors all better off, because they now have the cash in their pocket. There's no discount. And you can then go back to earning trust, because if you can earn trust, you can accumulate cash again. But don't bitch and moan about the fact that people don't like the fact that you have cash. You got to where you are because of your track record. You got to find. Do you notice that nobody complains about Google's cash? Have you read a single article that says, you know what, investors are complaining that Google has too much cash? When people complain about cash, it's almost always about companies which have a track record which makes you worry about the company. So cash, don't do anything revolutionary in your DCF. Take the cash, but before you just add the amount, ask yourself, is this the kind of company where investors trust the company? Because if they don't, maybe that explains why your company might come out looking undervalued. It's not because their operating assets are being undervalued, because people don't trust them with the cash. But I'm going to use this cash argument to take a little detour. You know how mutual funds are structured? A typical mutual fund is an open-end fund, which means when you send money in, the number of shares expands, and your net asset value of the fund is just basically the value of the fund divided by the number of shares. So when you invest $100, you get $100 worth of those assets. That's a tip. And 95% of mutual funds are open-end mutual funds. So you invest in Fidelity Magellan, you invest in Vanguard 500 Index Fund, you're getting an open-end fund. There are a class of mutual funds called closed-end funds. Closed-end funds actually trade on the market. So you invest in the company. And what they do is they take your money and invest not in projects or in businesses, but in other publicly held stocks. So if I ask you to value a closed-end fund, this should be a slam dunk, right? I say, look, this is my closed-end fund. These are the 10 companies they own. They're all publicly traded. To value the fund, what are you going to do? You're going to take each company, you're going to add the values up and say, this is my net asset value. And you'd expect the stock to trade at roughly the net asset value, right? Because you know what they own, you know what the value is. So closed-end funds should be the easiest of all instruments to price, because you know exactly what you own, you know what the pricing of those assets is. But here's one of the great mysteries in finance. I don't think it's a mystery once you start digging, but it's a mystery at least on the face of it. The typical closed-end fund trades at a discount of about 15 to 20% on its net asset value. You see why this looks like a mystery? Because what's your first reaction? Is this, when you think about any kind of investment scenario, one of the questions you ask is there a way I could make money easily off this? What seems to be an easy opening here, if you have enough money? If you have closed-end funds trading at a 15% discount on what they own, and what they own are publicly traded securities. Michael Ayers, what might you do to take advantage of it?
You could, are you able to hear me? Sorry.
Yep.
Yeah, you could buy the closed-end fund and short the stocks.
You don't even have to short the stocks. You buy the fund, you control the fund. Right after you buy the fund, what could you do? You remember, you control the company now. You liquidate the closed-end fund, which basically means selling these shares in the market. You should collect the difference, right? So one of the great mysteries is, why doesn't that happen? Why don't you see closed-end funds being taken over and liquidated? Because this isn't like a traditional liquidation. You're not selling land and building and factories. You're selling shares in Apple. So whenever you see a phenomenon like this and it's not happening, there must be some friction we're missing, right? So Michael, what might be that friction? What might stop you from cashing out?
I mean, could it be transaction costs?
One is transaction. The transactions cost today's day and age are small. So one of the things you worry about is that these are maybe the stocks you own are small, fairly liquid companies where selling a big chunk might cause a discount. So if that's the case, that might stop you. But if that's not the case, let's say you liquidate those stocks, do you get to keep the entire cash? What do you have to do before you kind of clean up? You got to pay taxes, right? So if you have a lot of taxes you've accumulated, it might look like the discount is there for the taking, but you try to liquidate it, much of it might disappear. The bottom line is closed-end funds continue to trade. They continue to trade at a discount, but some of them trade at a premium. And the question is, what explains the difference across closed-end funds? So I'm going to give you a very simple opening to think about it that's built on what we talked about with cash. Let's say you have a closed-end fund that invests in average risk stocks. And let's say, based on your assessment of the risk premium, an average risk stock should earn about 11.5%. But this closed-end fund has a history of delivering 0.5% less than your required return. Why? Because they pick the wrong stocks. They don't do a very good job. So when you do that, your returns are going. So they lag what they need to do by 0.5%. Can you give me a rough sense based on those numbers on how much the discount should be? Because I'm going to argue that this fund is now going to be discounted. Is there an easy way to compute that discount? Michael, do you want to stay on and try? I'll help you out. You invest $100 in this fund. What are you going to make each year? Let's make it a perpetuity. You're going to earn $11 a year, right? That return is. What do you need to make? 11.5%. If you make $11 a year in perpetuity on an investment that has 11.5% required return, the value of $11 with 11.5% discount rate is about $94, $95. You see what you've already done? If that's the case, your discount is going to be about 6% on net asset value, because this manager is expected to earn below expected returns. If he earns only 10.5% or 10% or 9.5%, the discount is going to get bigger. Closed-end funds, where you look at the manager and say, these guys are going to continue to lag the market, are going to trade at discounts. Closed-end funds, where you look at the manager and think, I think these guys can beat the market, are going to trade at a premium. I've been asked to write about SPACs. You know, the SPACs are a big phenomenon. Now everybody has a SPAC. Chamath Palihapitiya has, there's like 11 SPACs he started. I think he's all the way up. He's moving up the alphabet. He started with A. I think he's midway through the alphabet. I don't think he's going to stop till he gets to Z. Bill Ackman has a SPAC. Anybody want to help me out? What's a SPAC? What do you do? David, do you want to help me out on a SPAC? What is this? What exactly is a SPAC?
Sure. So it's like a blank check company. So you raise cash up front, $1 billion, $500 million, and then you find a acquisition target after the fact. And
is there something we can use from the closed-end fund argument to kind of understand SPAC? So what are you getting at the SPAC? You're investing in a closed-end fund that actually hasn't told you what they're going to put the money in.
Yeah, so you're getting the management team or the sort of investor in the same way you're getting the public equity investor in the mutual fund?
So why would you pay a premium for a SPAC then? So under what kinds of conditions would you pay a premium for a SPAC? What do you have to expect about the management team? That
they'll deliver returns above and beyond what you'd get.
And to deliver returns, because it's a very simple transaction, they do one IPO and they're done, they have to be able to find the right company and buy it at a price lower than its fair value, right? Somehow, that's what you're betting on, because if they pay a fair value, then there's really nothing added. The SPAC is just a closed-end fund without even the kind of limits that a traditional closed-end fund is, because you're right, that's why it's called a blank check company. You're expecting these SPAC promoters. Now you can see why a Bill Ackman can start because he points to his track record and says, look at what I've done in the past. Chamath is a lot younger. His reputation was he called the Bitcoin Zoom. So you're bidding on a different kind of skill set. Do you know that Colin Kaepernick has a SPAC? Now we can argue about whether Colin should be signed as whether somebody should sign. And I think there's a legitimate argument about whether you want to sign him on as a quarterback. But what the heck are you thinking? Putting your money with Colin and saying what skill set is he going to bring in finding the right target for you and getting it at a discount? So the next time you hear debates about SPACs, kind of relate it back, because this isn't something completely out of the blue. It's been done before. It's like a closed-end fund, and what a SPAC should trade at will be a function of what you think that promoter of the SPAC can do for you in terms of delivering excess returns. Which brings me to a name that you don't think you would see in a closed-end fund, Berkshire Hathaway. You think Berkshire Hathaway is not a closed-end fund? Well, what the heck is it? How does Berkshire Hathaway raise capital? I mean, what's the capital side of Berkshire Hathaway? It's an insurance company, Geico, right? You're saying insurance companies raise capital, that capital has been invested. Berkshire Hathaway has become the vehicle for one of the most, Geico is one of the best run, most efficient insurance companies in America. So you start with a good insurance company. Normally, insurance companies are pretty neutral in terms of being money managers. So typical insurance company, the value comes from, are you a good insurance company? Do you assess risk? How good are your actuaries, right? And Geico has all of those. But it's also, for the last 60 years, had the most famous stock picker in history investing its capital. Warren Buffett. So basically what you have in Berkshire Hathaway is a really good insurance company plus a closed-end mutual fund, right? Closed-end because when you buy Berkshire Hathaway, you're buying their holdings of Coca-Cola and Washington Post and See's Candy or whatever else they've invested capital in. And for much of its history, Berkshire Hathaway traded at a premium on a typical insurance company. So it was being priced as an insurance company, but a premium. And people say, what's the premium? It's easy to explain, right? The premium was the Buffett premium. You were paying because Buffett was picking your shares. So not only did you get the upside of a great insurance company, you also got the upside that he was picking great stocks. But take a look at this graph. If you look at the black line, that is actually what's happened to the Berkshire Hathaway premium as you go through time. It used to trade at about twice the typical. So if you look at the price to book ratio, very simple proxy for the premium. In the late 90s, Berkshire Hathaway traded at a price to book well above a typical insurance company, almost twice as high. By the time you get to 2019, it's actually trading at a price to book lower than the typical insurance company. In other words, the Buffett premium seems to be gone. I mean, you still read about Buffett all the time, but there is no premium left in the price. Kind of an easy one to talk about. So what do you think's happened? Why do you think the Buffett premium is gone? Manav, you want to try?
He isn't deploying cash, I guess. He says he just isn't really making investments these days.
How old is Warren Buffett?
Dinosaur.
92. If I just put his mortality in here, you can already see that even if he's picking stocks, which he stopped about 8 years ago, there isn't that many years left. I'm not trying to be morbid here, but he's not going to live forever. And as he ages, you're seeing people start to realize that. And it's also true he's not picking stocks as well as he used to. In fact, I have a paper in value investing if you want. It's on my website. It's, you can read it on what I think's gone wrong with value investing and why it's no longer working. I think it's a function of the times we're in, the kinds of companies that dominate the market. But you can see the premium disappear. So when you get into a debate about Berkshire Hathaway, this is something to consider, that premium is actually what the market assesses for the value added by Buffett to the company. And basically it's disappeared, it's gone. And it's gone for good reasons, right? So a twist on the cash argument, but any questions on that?
Can I check something on closed-ended funds? Just with the first line of questioning when you're speaking to Michael, it sounded like a reason for the main reason for the discount on a lot of the funds was the tax rate they would have to pay. But then it sounded like
no, that's not the reason for the discount. That's a reason why the funds continue to exist at the discount. So the question people ask is, why don't people just buy the funds and liquidate them? The problem is you can't liquidate and make the money. So these funds can be run by bad managers and continue to run without anybody intervening and stop, because this is value destruction, right? I mean, in a sense, why do we keep money in these funds if they keep earning less than the required return? The problem is liquidating these funds is really difficult because of the tax issue that overhangs them. That doesn't take away from the fact that they've done a terrible job then of investing in stocks, because that's what so the discount is explained by poor performance in picking stocks. Their continued existence is explained by the fact that liquidating these funds and capturing the difference is a lot more difficult than there are people who try to do it. They actually try to liquidate closed-end funds, but it tends to be difficult to do because of the tax issues, the transactions cost issues. And sometimes these funds are headquartered in parts of the world where getting to them is really difficult. Cayman Islands, some corporate governance issue that we haven't even thought about.
Thanks. And on the cash bit, obviously we went through the three examples, and just to make sure I have this right, our key takeaways just should be understanding that sometimes you might discount, sometimes you might attach a premium. I'm guessing
or more
of
generally, if you find your company, let's say your company is a company with a huge amount of cash in its balance sheet. Let's say 40% of the value of the company comes from cash, 60% from its operations. And you do a discounted cash flow valuation and you find this company is undervalued. What I'm trying to say is it might be undervalued because it has so much cash and people don't trust it with the cash. It's not because you got the operating assets right. Your key variable then becomes what happens to the cash. So the way you focus on how to make money in the valuation is you could buy the company, but if it never returns the cash, you're kind of stuck. You're never going to make the money back. So you have to hope and pray in those companies that a catalyst comes out that forces this company to kind of pay out much of that cash. So you're praying for a Carl Icahn to show up on the horizon if you invest in these companies.
Cool. Thanks.
Let's talk about cross holdings. I mean, there are three ways you can account for a cross holding. If you have 3, 4, 5% of a company and you take absolutely no role in how the company is run, it's called a minority passive holding. Let me explain how accounting deals with minority passive holdings. When you have a minority passive holding, you have to show only the dividends you receive on those holdings in your income statement, only the dividends. And your balance sheet, you have to show what you originally invested to get this cross holding. It's the furthest away you can get from reality because you're reflecting what you originally invested and you're showing dividends, minority passive. It's very uncommon. The more common one is what's called minority active. Minority active, here's what you do. In your income statement, you have to show, let's say you own 10% of a company. You take some role in how it's run. You have to show 10% of the net income or the net loss in your income statement, but you show below the operating income line. So it's better than dividends, but it's still below the operating income line. And in the balance sheet, you show what you originally invested plus or minus 10% of the retained earnings since. So it's like an updated book value. So minority active, you show income or losses, not dividends, and you update your book value. And then you get to owning 60% of a company. Accountants absolutely freak out. They insist you act like you own 100%. I've never understood this. I own only 60%. Why do you act as if I own 100%? They say, don't ask questions, just do it. So when I do my income statement and I do my revenues, I count 100% of the revenues of the subsidiary, even though I own only 60%. I say, I own only 60%. He says, don't worry about it. When I do my operating income, I count 100%. I say, I own only 60%. He says, don't worry about it. Get to the balance sheet, I act like 100% the assets, 100% the cash, 100% the debt. Each day he says, don't worry about it. Then he wakes up at the last one and says, but you own only 60%. That's what I've been trying to tell you all this time. You don't own 40%. Exactly. We have to show that in your balance sheet. Hence is born the most badly named item on the balance sheet. When you have a consolidated financial statement, you're only 60% of a company. You know what you're going to see on the liability side of the balance sheet? Sergio, do you have any idea what it's called?
Non-controlling.
That 40%? It's called minority interest. If you're not an accountant, let's have a minority interest. What's your first reaction? You must own something, right? Minority interest is a liability. It shows the 40% that doesn't belong to you. It's also called a non-controlling interest. And it's there because you consolidate. So what I'm going to do is take you through a very simple example. So you can see already with a simple example how things can get really messy with cross holdings. So let's say you valued a company. Let's call it company A. Let's not get creative. You come up with $1 billion by discounting free cash flows of the firm at the cost of capital. Company is $200 million in debt. Let's start easy. The value of the equity in this company is going to be $1 billion minus $200 million, which is $800 million, right? So we got the starting point. Now I'm going to make your life difficult. Aaron, you're going to help me out here. So I'm at 800 million. I said, oh, I forgot that this company owns 10% of company B. And those holdings right now are accounted for as passive holdings, and the market cap of company B is 500 million. So here's what I want you to help me on. I was at 800 million before I told you this, right? Now I've told you that they own 10% of company B, and I've given you the market cap of company B. Can you give me an updated value with this information? I can't hear you, Aaron. You got to unmute yourself. You're still muted, sorry. Bucky, you want to try?
Do we need to know what the dividend is if it's a passive holding?
Well, you're saying it'd be nice to know the financial. Let's say you don't have it. If you want an approximation, what have I given you that you might use as a shortcut? You own 10% of company B. What have I given you about company B?
The market cap.
The market cap, right?
500 million.
500 million. 10% of 500 million is 50 million. Should I add this, subtract it? What should I do? I have 800 million before I gave you this information.
In this case, you would add it if you're going to make any change to it.
And in fact, what's the question you asked? Have I counted it already? And the answer is no. Why? Because it's a minority holding. The income from minority holdings doesn't show up in your operating income and cash flow. So you're going to add the 50 million. So you're now at 850 million. Stephanie, I'm going to give you the toughest part of this problem. Oh, I forgot to mention that company A owns 60% of company C. Oh, and by the way, there's a minority interest that's being recorded of 40 million on the balance sheet. What is minority interest? It's a portion of the company that doesn't belong to you, and the accountants estimate to be 40 million. So we were at 850, right? After we dealt with the minority holding. Now, what do I do with this 40 million? Add, subtract, ignore?
I would subtract it.
And give me the reasoning. It's exactly right. The reasoning is?
It's the part of the company that we don't own.
Exactly, right? And this is exactly what analysts do. And already you can see the mess on my hands. And the mess is the following. The 800 million came from an intrinsic valuation, right? Free cash flow of the firm. The 50 million came from a pricing, right? It took the market cap. And the 40 million is a accounting book value. 850 minus 40 might give you an answer, but you're saying, what the heck have I done? I've created this multi-headed monster where each head has different characteristics. In a perfect world, here's what you would do. You would do an intrinsic valuation of company B and an intrinsic valuation of company C. This way you're not trusting the market and accountants. And if I told you the intrinsic value of equity in company B is 250 million, and the intrinsic value of company C is also 250 million. Dehu, can you help me out here? So if I've replaced now the market cap and the book value, and I've given you the intrinsic values of equity of the two companies, what would the value be? I'll start with the 800 million, but what's 10% of company B now worth?
So for company B, I think we would still need to add
25, right? 10% of 250.
Right.
And then what am I going to subtract?
We need to subtract the company C. That's 40%.
40% of 250, which is 100. So I'm going to take 800 plus 25 minus 100. But to get there, what did I have to do? I had to do intrinsic valuations of 3 companies because I wanted to value 1. And to do intrinsic valuations, you have to get cash flows, you got to get discount rates and growth rates. I have to have full access to the financials. In a perfect world, that is exactly what I would do. In fact, in a perfect world, I would value the parent company standing alone with its cash flows, its growth, its risk. I'd value each and every subsidiary standing alone with their cash flows, their growth, their risk. And at the end, all I have to do is do a summation, right? Parent company plus 20% of company A plus 15% of company B plus 60% of company C. The advantage is I now deal with each company on its own fundamentals and its own merits. This is pure intrinsic valuation if you have subsidiaries.
Professor,
go ahead.
I have a question. If you, if it is the book value of company, the second company that we were discussing that is on there, then why is it that we subtract the intrinsic value? Like, wouldn't there be cases?
No, I'm saying instead of subtracting book value, I shouldn't subtract that. The 40 million is a book value of the 40% of the minority holding, right? That's what the accountant puts in. I don't like that 40 million. I'm saying that's not a fair assessment. I should be subtracting out 40% of my intrinsic value, because when I did my first valuation with cash flows and discount rates, I valued company, the 60% holding company at its intrinsic value. I should be subtracting out 40% of that intrinsic value. So
okay, so it's you subtract the book value if you aren't able to subtract the
intrinsic. Exactly. So the first example is what people do in practice, either because they're lazy or because they can't get to the intrinsic value. But I'm saying if you have the ingredients to intrinsic value, then clearly you should do it from scratch.
And this is only relevant for the consolidated holdings, not the minority holdings, because those aren't reflected in the balance sheet.
It is relevant because you're buying shares in a company, right? And when you buy shares in a company, you get all of its cross holdings with that share. Sounds abstract. In fact, let me show you an example. Okay. Let's say in 2014, you were buying shares in Yahoo. By 2014, if you were looking at Yahoo, you had 3 pieces you had to value. There was Yahoo, the parent company. And what did Yahoo, the parent company, have as its primary driver value? A search engine that nobody searched on, and a mail program that only people who were over the age of 70 seemed to be using. So it was a dying company. Google had killed it. So in 2014, I decided to value Yahoo do an intrinsic valuation of Yahoo. So I took the cash flows. So basically, I took the operating assets and did a valuation. Came up with a value of about 4.4 billion for the search engine and the operating assets. You had cash to subtract our debt. The value I'd have ended up with for the equity would have been 7.4 billion. And that's the first column. So basically, in the first column, you have my value of equity in Yahoo's operating assets. Yahoo's actually trading at about $40 billion. If I'd stopped right there, what's my reaction? People have gone crazy. What are they paying for? But here's what I was missing when I valued Yahoo's operating assets. They had 2 minority holdings. One was 35% of Yahoo Japan. That's actually a standalone publicly traded company. And don't ask me why, but the Japanese still seem to use Yahoo to search for things. And they have full financials. So I went and valued Yahoo Japan, and Yahoo Japan is worth about $18 billion, the operating assets. And if I bring that in, the 35% of the equity in that adds another 7.4 billion. So in addition to the 7.4 billion that they have in their operating assets, the 35% of Yahoo Japan on an intrinsic basis was worth 7.4 billion or 7.34 billion. But I'm not quite done. This was just before Alibaba was going public, and its financials had come out in the prospectus. So I had all the financials. And Yahoo owned 21% of Alibaba. You know how they ended up owning 21%? They were one of the original venture capitalists who supplied capital to Jack Ma. They owned 21% of Alibaba. And I valued Alibaba. The value of Alibaba's operating assets is 127 billion. That cash, you subtract our debt, 21% of the equity in Alibaba is about 32 billion. So here are the three pieces of Yahoo. There's 7 billion from their operating assets, another 7 billion from owning Yahoo Japan, and another 32 billion. But when you're buying Yahoo shares, you know who you're really buying shares in? Alibaba. And this is why when Marissa Mayer was hired at Yahoo, remember she was hired and she was given an objective. Make yourself the next Steve Jobs. Make Yahoo the next Apple. I remember writing about it then, and I said, this is no reflection on Marissa Mayer, but there is no way Marissa Mayer can pull this off, because she controls the rump of the company. On any given day, what Jack Ma does at Alibaba has a much bigger impact on Yahoo's value than anything she can do. So when she bought Tumblr for $1 billion, there's all this press about this will turn the company around. I said, how can it? This can't change the value. This is you're playing with this small piece of value. But to do this, I was able to do this because I had the full financials for all three companies. So I had to wait till Alibaba actually filed its prospectus, because until Alibaba did that, that 21% of Alibaba would have been difficult to estimate. Ali, you're saying something? You're muted or no? Okay.
I'm just like wondering to myself where you would find it stated on like the 10K, these holdings.
It has to be because when you own these cross holdings, it'll always be in the footnote. So basically the first thing you will notice in the balance sheet, it'll say investments. And there'll be a number next to it. And if you go to that footnote, in the footnote, they have to tell you what their long-term investments are. And they have to show these are, so the disclosure is there, but that's just the easy part, right? Because once you get the disclosure, you then have to go looking for the full financials of these companies and then value both companies.
Thank you.
Now, do you see why most people don't really value cross holdings fully? It's a lot of work. So I'll give you a shortcut. You might not like it, but it's a shortcut. Especially, don't do it for a company like Yahoo where you have these big cross holdings. But let's say you have 20 cross holdings or in small cross holdings. You don't want to value 20 companies. So here are the shortcuts. One is you can take the book value of the holdings, which is in your balance sheet, and apply a price to book ratio. You know what I'm doing, right? I'm pricing. I'm saying, look, I'm too lazy. You told me the book value is 40 million. Typically, chemical companies trade at 2 times book value. I'm going to multiply the 40 by 2. That's my estimated value. It's a shortcut. It's sloppy, but think how much time it would save you. And if you have minority holdings in publicly traded companies, people push the shortcut to the limit, right? They say, look, I already have a market price for Alibaba and Yahoo Japan. Why would I need to do a valuation? Let me just take the pricing. And the problem then is, if Alibaba is mispriced, Yahoo is also going to be mispriced because you feed everything in. So in fact, with Yahoo, I also did a pricing. I said, look, you don't like this intrinsic value stuff with all the information. I can do a pricing. And to do a pricing, I'm going to apply a multiple. An EV, in this case, I used EV to sales multiples to get a pricing for Yahoo Japan and Alibaba. And I could have priced all three pieces if I wanted to. But I was being consistent. I priced all three pieces and said, this is a pricing. It's not an intrinsic valuation. And it's a shortcut. It gets me to an answer. But in this case, the answer I got was pretty close. I ended up buying Yahoo after this investment because of the value, the pricing worked out the same way. But when you have a lot of subsidiaries, you might have to pick your fights. You might not be able to do it right, either because you don't have the information, or even if you do have the information, getting to it. In fact, I'll close my cross-holding section with a story. This is about 20 plus years ago. I was doing, I remember, second or third edition of one of my books. And I was valuing a Japanese company, late 90s. And valuing a Japanese company in the late 90s, you were always teetering on the edge of disaster because the risk-free rate in yen was so much lower than the risk-free rate everywhere else in the world that if you use numbers you were used to using for growth rates, valuations would blow up. So I valued this Japanese company. I'm really careful. I finished the valuation. I'm patting myself on the back and I'm reading their annual report. I get to the balance sheet. There's this line item that says investments and I go look at the footnote. And the footnote runs 7 pages. They have 226 cross holdings. 226 cross holdings. My task is laid out for me, right? If I'm a careful, serious analyst, what should I now do? Value each of these two. There is zero chance I'm doing that. To value one company, you want me to value 227? And even if I'd wanted to, I couldn't have. Here's why. 166 of those cross holdings were in private businesses and there was zero information, absolutely no information provided on those businesses.
Such a good job.
Ooh, I'll sit in my new chair.
Somebody's mic is open. If you could.
It's time for my daily.
I see the mic, sorry. So even if you knew, even if you wanted to do it, you wouldn't have had the information. So I called the investment relations officer for this Japanese company. Okay? And she's very polite, very Japanese. And I said, look, I'm valuing your company and it's not for an expose, but I need some information on your cross holdings. She said, I cannot give you that information. I said, why? She said, it's proprietary. The way she said proprietary was kind of scary. I was kind of intimidated. And I said, that's funny. If I bought 1,000 shares in your company and then called you, would you give me the information? She said, it'd still be proprietary. I said, that doesn't make any sense to me. If I own 1,000 shares in your company, I'm part owner of your company, you're refusing to tell me what I own. She thought about it for a moment and said, you have a point, but it's still proprietary. At this stage, I'm banging my head against a brick wall. So why am I doing this? I get ready to hang up the phone. She said, wait, I do have something useful I can tell you. I said, maybe she's going to give me what revenues the companies have or what income they generated. I said, what? She said, I cannot give you specifics, but I have to tell you these cross holdings are worth a lot. I said, lot? I mean, I'm trying to enter that in my Excel spreadsheet, LOT, it's coming back with an error message. How many zeros are there in a lot? She said, I can't give you specifics. This cuts to the heart of the cross-holding culture, right? Because what do managers do? They hold up a brown paper bag and say, trust me, it's full of cash. Say, can I look in the back? No, I'll tell you how much there is in the back. That's basically what companies with cross-holdings do, right? They tell you, hey, here's how much the cross-holdings are worth. Take my word for it and run with it. If you're valuing an Asian company, a Spanish company, many Latin American companies, this is more the rule than the exception. The typical company comes with cross holdings. Try valuing Samsung. They're all connected at the hip. Every Samsung company is cross holdings in every other Samsung company. Try valuing a Tata company. Every Tata company is connected to every other Tata company. This is not the exception. This is the rule. It's a nightmare in my view when you create this. And we'll talk a little bit about what you can do to kind of penalize companies that get the bulk of their value from cross holdings. But we know what to do with cross holdings. It's just we don't have the information. We're just overwhelmed by the number of cross holdings you run into. So we've talked about cash, we've talked about cross holdings. Let's talk about mopping up. And the simple rule is don't double count. Don't count a cash flow and an asset in the same valuation. That's not allowed. You're looking for truly uncounted assets. I'll give you a couple of examples that might be reaches. The late 90s, stocks were going up so much in the US that many companies that had pension funds were overfunded. Now, pension funds are now history in the US. Most companies don't offer pension funds, but for a long time, if you went to work for a US company, you had a pension plan. And the pension plan could either be a defined benefit or a defined contribution plan. You know what the difference is? Defined contribution plan, you'd set aside 2%, the company would match it, they'd invest it somewhere. And when you retired, you would get whatever that money had grown to. So the company took no risk. A defined benefit plan, the company actually promised you a dollar pension, $600 a month starting at the age of 65. And because it's made a promise for that defined benefit, it has to invest in assets to cover that defined benefit. So if your value of your assets is enough to cover the expected benefits, you're a correctly funded plan. If the value of the assets is less, you have an underfunded plan, which means you have a problem. You've got to make up the difference. But if the value of your assets is greater, then you've got an overfunded plan. And technically, that overfunding belongs to shareholders. So there are many analysts in the late 90s who would take this overfunding and add it onto the value of equity, saying it belongs to equity investors. There are two glitches in that process. One is it's not easy taking money out of a pension plan. There's actually a tax consequence to pulling money out once it's in a pension plan. The second is you can kiss labor relations goodbye after you do that, because no union is going to say, that sounds okay, just take the excess money out. So capturing that additional value is actually very difficult to do, but you do get a benefit, right? The benefit is now that you have an overfunded pension plan, you need to set aside less money in the future to kind of cover your pension plans. But what you're really looking for are assets you haven't counted yet. So you're looking for truly vacant assets. And you saw with the example, it's really, you can't count patents, you can't count a headquarters building, because those are counted. So I'll tell you a story to kind of illustrate what a truly unutilized, it's kind of a left field story, but kind of hang in there. Michael Price Fund is still around, right? I mean, any of you in the Michael Price Fund? No, it's online, I don't know. The Michael Price Fund is actually a fund at Stern that was funded about 20 years ago by Michael Price. He gave seed money for Stern MBAs to be able to manage money. So basically, Stern MBAs manages fund, they pick stocks to buy, so they run it as a team. And every 2 years, of course, the team kind of passes on to the next. So it's and you can go back and look. They actually, I think online, they report their track record. It's not bad. It's at least as good as the next best active money manager, which might not be saying much, but it gives people a chance. I have never been officially involved with the Michael Price Fund. But a lot of people who go into the fund end up going through this class. And the way the fund works is when you want the fund to invest in a stock, you make a sales pitch to the rest of the group. And if you succeed, they buy the stock. This is about 15 years ago. I'm sitting in my office. One of the students in the class at that time was in the Michael Price Fund. He comes into my office and he says, I'm facing a conundrum. I very quickly turned to my computer, typed in the word conundrum, and because I had no idea what he was talking about. It turns out he was confused. I don't know why he didn't just sound confused, but this sounded more profound, I guess. I said, what's your conundrum? I like the words. I was going to use it on him as many times as I could. He said, I'm valuing Playboy. I said, I don't see a conundrum yet. He said, I value Playboy at 240 million. The stock's trading at 300 million. I said, I still don't see a conundrum. He said, here's my conundrum. 7th time in like 2 minutes, we used the word. And I said, Playboy has one very big asset I haven't counted in the 240 million. You know what he was talking about? Anybody have any idea what he was talking about? Don't tell me it's the bunnies. They're all in the cash flows already. What do you think he was talking about as a Playboy asset that hadn't been counted yet?
Was it Hugh Hefner's personal residence?
Which is?
He has a large mansion
Playboy
in LA.
mansion in LA, right? So if you've ever driven by it, it's one of the most valuable pieces of property in LA. At that time, the estimated value of the property was about 150 million. Do you see what his conundrum was? Playboy owned the property, and if you add the 150 million to the 240 million, that's 390 million. That makes it undervalued. So he was asking, can I count the 150 million? Technically, it belongs to Playboy, right? But there's one small catch in monetizing that 150 million. At least at the time that he walked in, there was an 80-year-old hanging out in the mansion, usually in a bathrobe, that he couldn't exactly throw out in the street. You have to. So he said, what should I do? I said, check out the actuarial tables. He said, what am I checking for? I said, check out to see how long 80-year-olds who surround themselves with 25-year-old playmates tend to live. It's a lot of stress on your heart. Let's say it's 5 years. What's the next step? Take the 150 million. You're going to sell it 5 years from now. discounted back 5 years. If you want to get fancy and use a real estate cost of capital, be my guest, and add it on. That is a truly vacant asset. And I didn't think I would ever see the story again, but about 6 years later, I open up the Wall Street Journal and I see a story where Playboy pulled off this most amazing trick. They sold the mansion with Hugh Hefner in it. You see, that's strange. The guy who bought the mansion was a Greek billionaire who paid $200 million for the mansion, but the condition was that Hugh Hefner could stay in the mansion till he died. The minute after the transaction went through, Playboy's cash balance increases by $200 million. Hugh Hefner has been shunted off to somebody else's house now. This is a truly vacant asset. This is the kind of, so when you look at a balance sheet, you're looking for Playboy mansion type of assets, and most of your companies, you might not find it. But think about that. Those are the kinds of investments you haven't counted yet. Which brings me to my final example for today. We're going to, early in the start of the class, I said, when you look at two companies, they're not all equally difficult or equally easy to value. Some companies are easier to value than others. So I'm going to give you two companies. Yes, go ahead.
Sorry to interrupt you. I just had a quick question about incorporating uncounted assets. Right. Aren't these assets already on the books of Playboy?
But remember, when you do a DCF, you don't do a book, right? What do you do in DCF? You take earnings and cash flows. If an asset doesn't show up in earnings or cash flows, the fact that it's on the balance sheet doesn't help you. That's when you do DCF-based valuations, all you're looking at are earnings and cash flows. If you have assets in your balance sheet that have value, that's why the Picassos came in. You might own the Picassos, you might show them at fair price, but I haven't built them. They don't produce cash flows for me.
So I'm just trying to understand where this gets incorporated. So would this be in the market value of debt equity in there?
No, it doesn't get incorporated anywhere. It's a loose end. So after I'm done with my DCF, you know how I add cash? Then I'm going to add uncounted assets. And that's going to push up my value. And yeah, that's basically it. It might show up in my debt to equity ratios, but that doesn't really affect my DCF that much anyway. The cash flows and the earnings don't reflect any of the numbers. So let's do one final example for today to kind of illustrate complexity. So I'm going to show you two companies, and I want you to think like investors and tell me which of these two companies you would value more highly. The two companies have exactly the same numbers, same operating income, same tax rate, same return on capital, same cost of capital, same growth rate. So all the numbers look the same. But here's where the two companies are different. Company A is in a single business, Company B is in multiple businesses. Company A is a very simple holding structure. You can see exactly what they own and they're pretty direct about it. Company B has special purpose entities, all kinds of crazy stuff going on. Company A is transparent accounting statements. They describe what they do and it's pretty easy to understand. Company B has opaque accounting statements. Basically, you have no idea what they're saying. So I've set up the example, right? Courtney, you're going to help me out here. I have a simple company and a complex company. The numbers look exactly the same. Would you value one of these two companies more highly? And if so, why? The simple or the complex?
It's probably easier to get a more accurate reading on the simple one because then you don't have to add in the different complexities.
So you're saying you'd pay a discount on the complex because there are things you don't know about the company, right? The things they're holding back. No. And I would agree with you. But here's the problem. You open up my DCF, my valuation book, you start plugging numbers into a DCF model. You know what you're going to end up with? The same value for the two companies. There's nowhere in discounted cash flow valuation where I ask you how difficult was it to get the growth rate. Once you enter the growth rate, I put that growth rate in. You know why in traditional valuation we ignore complexity? We make a very dangerous assumption about what you don't know. We assume that what you don't know will average out in a portfolio. If you own 100 complex companies, things will average out. And the reason it's so dangerous is think about what it is about company B you don't know. It's what managers in that company have chosen not to tell you, right? And then let me ask you a follow-up question. What do managers hold back? Good news or bad news?
Usually bad news.
When was the last time you had an accounting scandal you woke up to where the company said, hey guys, we made 5 times more money than we told you we did? It's always one-sided, right? complex companies, there's more you don't know, and it's more likely that what you don't know will hurt you than help you. You know, when this came to the surface in evaluation class, it was in 2001 when Tyco had an accounting scandal. Tyco was a conglomerate. It grew through acquisitions, had a huge accounting scandal, lost 70% of its value. And while Tyco was losing 70% of its value, GE lost 15% of its value. He's saying, why if Tyco has an accounting scandal, would I punish GE? You see how investors were thinking, right? They said, Tyco fooled us with this acquisition process. They covered a lot of bad stuff. GE is a conglomerate that goes through acquisitions. How do we know GE is not doing it? And I remember somebody in class saying, well, should we be thinking about this when we do valuation? I said, yes. But then if I want to bring complexity into valuation, there are two questions I need to address, right? One is I need to measure complexity. Because without it, I know, how do I decide what's complex, what's not? And second, I have to convert that measure into something in my cash flows, discount rates, growth rates, cash flows. So next session we're going to start with that question. When you're looking at a complex company, where in my valuation, how do I first measure complexity, and where in my valuation can I reflect that complexity? So I will see you on Monday. Any final questions before we end for the day?
Professor, I had one quick question for you.
Go ahead.
So this goes back to the value of cash. And I just wanted to kind of test this like framework with you. I think this is what you were saying, but if ROIC equals cost of capital, then the value of cash is neutral. And I know there's other factors that play into it, but generally speaking, ROIC is greater than cost of capital. It could be a value creator. ROIC is less
but
than
add
cost
the
of
second
capital.
criteria. ROIC is greater than the cost of capital and you face capital constraints, then it could be a value creator, right? Because if your ROIC is greater than the cost of capital, but you can raise as much capital as you want, I'm not going to reward you for holding cash because you can always raise the cash. So when a Google holds 100 billion in cash, I'm not going to attach a premium to the 100 billion because if they really want to raise capital, they could raise it in a second. The reason I made it an Argentine company was to introduce both the capital constraint and the fact that you have good projects. So if ROIC is greater than the cost of capital and you have a capital constraint, then you will have, cash trading at a premium. But in every other case, cash will be neutral. Right.
That makes sense. But then no matter what, if your ROIC is less than your cost of capital, it's a wasted asset.
And it's really not that your past ROIC is less than the cost of capital. It's the guys who took those bad projects are still running the company. And you worry about what they can do with the cash. So you're not punishing them for past projects. You just worry that what they did in the past projects, they'll continue to do. So one way they can fix it is they can all fire themselves and get replaced by management that you trust. That's why overnight you can have a discount disappear if a new, more competent management team showed up and he said, you know what, I trust these guys. It's all about trust.
Got it. Thank you.
Okay. Can I ask a quick follow-up to that?
Sure.
So you said in that the same way you can remove the discount is to distribute the cash.
Mm-hmm.
Am I missing something, or does that only work if I'm already a shareholder? If I'm not a shareholder, do I then need to reduce the equity value of the company if I assume that they're going to distribute the cash?
It'll reduce it, and basically what will happen is post-distribution, the value per share will be lower. Why? Because the cash has left the company. The price per share will also be lower, right? Because if you do a dividend, so take the special dividend case, the price. But what will happen is before you did this, your value was 10 and the price was 8 and the stock looked undervalued. Now the company has gotten rid of 40% of itself. The value goes from 10 to 6. So basically the price drops from 8 to 6. You're saying that's bad, but I get $4 in dividends in my pocket. So even though my stock price is down $2, existing investors feel happy. Outside investors no longer see this company and find it undervalued. They find it fairly valued because the discount is now gone. So as an outside shareholder, you will see a lower stock price, but you'll also see a lower value because the cash is now out of the company.
Got it. Thanks.
Yeah.